Hello, everyone. It's a wonderful rainy Saturday out today, and I hope your weekend is beginning well. Rates have been doing very well. There's been some interesting things tugging and pulling on rates as of late. We'll get into that in a second. 30-year fixed rate, 4 3/4. 15-year, 4% even. 5/1 ARM is at 3 1/4. 7/1 ARM, 3 3/4. FHA is at 4.5. VA, 4.625, and USDA is at 4 3/4. Now, on Thursday, the initial jobless claims number came out, and it was a little bit higher than expected. 35,000 increase to 445,000 initial jobless claims. That was above expectations, which were at 415. Now, you might initially say that that's not the greatest news, but from what I understand, that's more of a paperwork backlog as far as the increase is concerned. During the holiday season, the unemployment offices aren't open all the hours they normally are, and not to mention, unemployed workers aren't feeling so great to go out and make claims during this time of the year anyway. So, putting those two things together would be par for the course that the number would be a little bit higher than normal. So, we are actually noticing an improvement in the jobs market, and so those numbers aren't that surprising. Now, that would have actually helped rates on Thursday, but they were held a little bit at bay as far as the improvement was concerned by some hot inflation news. Now, the producer price index, which is basically an inflation number at the wholesale or producer level, that came in at 1.1% increase in December. Expected was a 0.8% increase. So that's a rather, healthy increase as far as inflation at the wholesale level. Now, year over year, we're at a hot 4% increase. So that actually should be spurring on a question. And that question would be, well, who's paying these increased producer costs? Well, there's two things that could happen. It could either be the consumer that has charged those increased costs, or the company, the economy as a whole would be eating those costs at the wholesale level. Well, the next data that came out on Friday would give us a little bit of a clue as to what occurs and whether the consumer is passed on those costs. The core, or I should say, the consumer price index rose 1.5% in 2010. Now, that's also the smallest gain that we've seen over 2 years. Now, the core CPI, which removes the volatile energy and food costs, that rose 0.8%. But you also have to keep in mind that that's the smallest gain that we've realized in core CPI since the data began to be collected in 1958. So we've most definitely not seen a great increase in core CPI costs. Core CPI just in December was an increase of only 0.1%, which also met expectations. Now, retail sales were also below expectations as well. So we can then determine that the consumer was not passed on those costs. We're still in a somewhat slow economy. It's growing, but at a very slow rate. Our labor market is improving, but also at a very slow but somewhat steady rate. So it's going to be a little bit time to come before we see some better improvement in the economy. So we need to stay encouraged. We need to understand that rates are fantastic right now. We should be screaming that out loud to our clients. Keep encouraged and know that it's a fantastic time to buy right now. So I hope you have a great weekend, continuing great weekend even on Monday being a holiday. So we will see you on Tuesday. All right, have a great one. Bye bye.